Welcome back. We are with David Burrows. Let's get back to the phones. Jerry in Vancouver. Hi, Jerry.
Hi, Anita. David, can you give me your view on Tech Resources? It's dropped like a rock. Do you see any shall I hold on to it or shall I get rid of it? And what do you see any hope for this for me in the year? And Anita, could you give us a street consensus, please?
You bet. Thank you, sir.
Okay, so Jerry, remembering that these commodity stocks are vulnerable when people get concerned about the economy, especially some of this global trade. Most of them put in lows in 2015, which was probably a sort of a cycle low, and most of them have started to sort of rebuild their bases and so on. Tech has been very weak recently, and most of the miners have come off their most recent highs.
Right.
If I were going to buy a metals producer right now, I would probably look at a Rio Tinto. And Rio Tinto recently made a new 5-year high. So came off the same lows in December 15 that Tech did, but basically rallied from $20 to $60. It's pulled back, like Tech has, to just above $50, $51, $52, and is sitting sort of on a rising moving average. So I would be more inclined with a Rio or BHP, which would be in the same camp, more sort of iron ore focused. Both of them look pretty good technically. The Tech is kind of broken down. I think I'd stay clear.
Okay, Jerry, I'll still provide you with that consensus there on Tech Resources. We have 19 buys, 4 holds, no sells, with a 12-month price target of $29.07. Thank you, and thank you, sir.
With just as a point to clarify, with both Rio and BHP, you're looking at north of 5% dividend, right? Which is quite attractive. So if you think, and my premise is that we're going to see a reacceleration late this year, early next year, and we get a soft landing. This is the kind of dividend stock I'd like to own, because you're going to the more economically sensitive sectors are really underowned currently, where the defensive sectors that people have been looking for yield are really overowned and really expensive versus history. I think the risk reward's much better here.
Okay, yeah, it's certainly playing to our audience with respect to dividends and, more importantly, dividend growth. David, thank you for that. Let's get to that tweet now from Smarter Squirrel. Wants to know about Shake Shack. What does David think about this company? He says he believes Goldman Sachs has a $95 price target. It reported yesterday and is up a lot today. He bought it below $34, holding for the long term. Should he add to his position, David?
Okay, this goes back to consumer, right? We love companies that have a great formula that can roll out a ton of stores, okay? So we watched Starbucks do it, we've watched Chipotle do it, Shake Shack is doing it. They're really only in about 26 states so far. They've got about 208, 210 stores. There's a long playing field in front of them. Now, here's the downside.
Okay.
These secular growth stocks trade at high multiples. So when they disappoint, they can be volatile. So they need to be one of several positions in a portfolio. We own Starbucks, we own Chipotle, we don't own Shake Shack, but we like the whole sector, and I think that it's one for a more aggressive, growth-oriented investor. You could own it. Just understand that if they disappoint at some point, there could be an air pocket.
Dare I bring up the China play again? Starbucks, very exposed to China. We know that the homegrown company there, Luckin, certainly eating into its space. Chipotle, not a China play, though. A lot of folks are bullish on Chipotle. Your thoughts? You're shaking your head.
Look, Starbucks has so many levers to pull, right? And they have such a predictable business. Stock basically consolidated from 2015 through the end of 2018. Numbers reaccelerated. I think that it's a great company. You look at how it's acting. There's a little pullback. Okay, so it's pulled back from like $100 to $95. It gapped higher on the most recent earnings. When you look at where the gaps are on the chart, gapping higher, it gaps higher because they keep beating estimates.
Okay.
That's a company I want to own.
There you go. All right, we squeezed one in for you. Starbucks. Let's get to Larry now in Toronto. Hi, Larry.
Good afternoon, Anita and David.
Good afternoon.
My question is on Microsoft. It's my favorite holding. David, if you could give me some comment about the stability of this company going into trade wars, market gyrations, the revenues it gets. How would you comment on that aspect of the company, the stability, and what you think of it going forward? Thank you.
All right, thank you.
Okay. So I looked at using this as a top pick today, but I've used it so many times I thought, they're going to think I don't know anything else. Microsoft is a great company. It's one of our very biggest holdings. We started buying Microsoft when they started converting from selling it once to a subscription-based service, right? Software as a service. They have just a dynamite connection with their clients. And so when you get into building out the cloud business, Amazon is great and AWS is a wonderful piece of Amazon. Microsoft has the sales force that already has relationships with enterprises all around the world. So 50% of their sales come internationally. But remember, they're paying for this monthly. This is not something that's likely to have a tariff put on it on software. So I like the stock. It has continued to outperform the market. It was one of the first stocks to come back and make a new high after the low in December.
Absolutely correct.
I said earlier, the first stock to double is the first one to double again. It trades at just under 30 times earnings, but it's a highly predictable business. So they've grown their dividend 10% a year. It pays you a 1.5% yield. They generate a ton of cash. I think this has got to be a piece of almost every portfolio.
Okay, we're going to find out a few more stocks that you're bullish on coming up next in our top pick segment. David, thank you. Folks, we'll see you on the other side.